Is the silver squeeze a hoax? Are you being ripped off with the premiums? And why is gold underperforming inflation in 2022? We're going to get to the bottom of all of it because I got a fantastic guest on the program, Dana Samuelson. He's the president of the American Gold Exchange, and I'm really looking forward to the discussion. I met him in New Orleans, and now we're going to do a quick follow-up here. Stay tuned for just a second. We'll be right back. All right, welcome to SF Live, everybody, the official part. And as I mentioned in the intro, I'm being joined by Dana Samuelson. He's the president of the American Gold Exchange. And Dana, we met in New Orleans and couldn't catch up there in person, but I promise you we'd do it now. And I'm really looking forward to what you have to say.
Hi, Kai. It's great to see you again. It was fun meeting you in New Orleans, and be great to catch up with you here.
Yeah, absolutely. And Dana, let's dive right in. Let's start with your presentation, actually. I didn't get a chance to catch it, but Brian provided me with the links to the presentation, so I'm going to work my way through it. And I think everybody else can sign up at neworleansconference.com to pay for the replays as well. We'll put the link in the show notes. But why is gold underperforming inflation in 2022 was the title of your presentation. Give us a quick summary and what were some of the key takeaways?
Well, it's all about the dollar being abnormally strong in the world over the last 6 to 8 months. The U.S. economy is a safer economy. It's performing better than Chinese economy, Japanese economy. Europe is certainly in a lot of trouble because of the war in Ukraine. Great Britain's economy is underperforming. So, and our interest rate differential, what we're paying on our bonds here, is higher than every other country's as well. So, for safety and for yield, money from around the world has moved out of most other places and into the U.S., and the gateway is the dollar. So the dollar has surged about 20% on average against the yen and the euro and the British pound over the last 6 to 8 months, which is a tectonic move. It's a gigantic rocket ship move higher, and gold tends to trade inversely to the dollar. So a higher dollar pushes gold lower, and we're seeing gold trading today about $1,650 US, which is well under the $1,750 to $1,950 range it's enjoyed over the last 2 years, and especially during a period of high inflation. But if you go back to the 70s, when we had 3 inflationary waves, gold lagged, and then it played catch up with a vengeance in the 74, 75, and then again in 1979, 1980. So gold climbs a wall of worry. We've seen gold take a punch up higher when the British gilt problem revealed itself. You know, who knew the British pension funds were leveraged in their gilts, and that's all they had to sell when they got a margin call on their own gilts. So it created the death spiral. You're aware of what happened there. So there's a lot of black swans lurking. Whether they emerge or not, we'll see. But right now, gold is on sale, especially in dollars. It's not on sale in euros, though, or in Japanese yen, or in British pounds, or other currencies that have declined. It's just on sale in dollars.
Unfortunately, that overweighs like the sentiment in general, because here in Germany, as you said, we're trading at record levels gold price right now. But the sentiment overall is just bleak. Like when I look at it, and I'm coming from the junior mining stock angle and junior exploration angle as well. If it was all European focus, if all the juniors were trading in Frankfurt, I think the mood would be pretty honky dory, to be honest.
So we have 2 distinctly different viewpoints right now. What I see in my country and what you see in your country.
Absolutely. Yeah. Very, very different. And it's going to get more extreme, I think, in the next 3 to 4 months. We'll see how the winter turns out. But we're not going to go towards energy policy now. We're going to talk differently. We're going to stay on the precious metals for a second. And I want to talk US dollar gold for another second. That correlation. I'm just looking at the gold chart here and the DXY this morning as well, following the Fed meeting yesterday, or the Fed statement yesterday. It seems like they're trading, at least today. What a massive time horizon, right? But at least today, in tandem. Gold is going up after it dropped. Now it's going up with the DXY this morning, which I find really interesting. DXY back to 112. Like, where do you think this is headed? Do you think the correlation will stay the same, meaning gold going down, US dollar going up, or will they actually move in tandem? Because I think there are certain scenarios where that can be the case. Long question.
Well, there are, but those are unusual times when they trade in tandem. You know, right now, today, for a couple hours, yes. The dollar has peaked on the DXY at about 114. It's about 112 today. Yesterday it was about 110. So following the the Fed statement, and then especially Chairman Powell's comments, which were very hawkish and more hawkish than most market participants expected them to be, the dollar caught a bid and gold got pushed back down. So I do think gold is basing in dollars between about 16 and a quarter and 16.50. And the dollar has probably peaked at 114 on the DXY, but we're in a period of stabilization now where it'll be hard pressed for the dollar to go a lot higher or gold to go a lot lower from here in dollars.
If you would have chatted yesterday, I would have asked you the question, do you think the US dollar has been losing steam? Because if I looked at the DXY chart, for example, in comparison to the other currencies, it's sort of, as you said, it peaked at 114, it went down to 110, but now we're trading at 112. So really like flatlining over the last like 30, 40 days almost.
Yeah.
Right? So it seems like it got a bit of an impulse yesterday. Do you see new highs in the making there, or are we just going to be range bound for a while until the Fed is a bit more clear in what they actually plan to do?
Well, it's completely Fed related right now. And how high will the Fed go? Most markets were gaming that we would get a 3/4 point rate hike, which we got, and then a 0.5 point rate hike in December, with maybe 1/4 point rate hikes going forward as they wait for the lag effect to catch up to the economy for what the rate hikes versus when the economy feels it here in the United States. But Powell clearly put on the table yesterday that we could get another one or two more 3/4 point rate hikes, which is what caused the dollar to catch a bid. Now, I think most of the move has been made. It's possible that the dollar could go a little over 114 on the DXY early into next year, depending on what the Fed does. But we are getting weaker here in the US economically, and we are headed towards a recession. It may not be a bad one, but clearly the economy is weakening in a lot of different forward-looking metrics. And remember, the Fed tends to look backwards, not forward. So once the Fed sees the effect of what they've done, they may not be breaking as hard, which would tend to make the dollar come down and gold in turn rise. Then that's what we were expecting yesterday to be announced, but that wasn't the case. So that was the surprise. So we're probably range bound with the bias still towards the dollar being a little higher and gold being pressured a bit.
Yeah, interesting. Like Powell said something that about the soft landing, and he said, "Well, the window for a soft landing is getting smaller and smaller." I think that's quote. I was like, "What does that actually mean? Like, is it going to be a hard crash? Because eventually the market's going to catch up, and as you said, it's always reactionary. Like the Fed rate hikes. I'm just looking at the mortgage rates as well. They're exploding. But at some point, there's going to be a massive trend reversal where house prices just have to crash. Like it just won't be just a slight decline or a transitory decline or whatever term you're looking for. And what does that mean, that soft landing, the window for a soft landing is getting smaller? And what does he expect to happen?
Well, I'm not that sophisticated an economist, but we are seeing housing prices coming down sharply and new sales falling dramatically because mortgage rates are so high. A hard landing would mean, we're getting a deeper recession than a shallow recession. And right now, the unemployment tends to be the one good aspect of the U.S. economy, where a lot of people can work who want to work, and there are more job openings than there are people who want those jobs. But jobs are the last thing to go before a recession. If you look at employment cycle figures over the last 20 years, the last thing to really roll over are jobs. So that's not what I would be looking at. We're looking at manufacturing and inputs for manufacturing, and they're clearly getting weaker over the last 3 or 4 months. Not in contraction yet, but back to real low growth as far as producers making things and orders. We're seeing inventory start to back up a little bit, prices coming down a bit. So inflation is waning a bit here in the U.S., but it's not going to go much below 5 or 6% if we get that lucky in the short term. So we are seeing effects of what the Fed's already done, but really we won't feel the full effects until probably the first quarter of next year. And then we'll really know whether we're going to get a soft or a hard landing. And I think that's what Powell was meaning.
No, thanks for clarifying that for us. Let's switch gears a little bit. Let's talk about more on the physical side as well. And again just looking at the gold and silver price, and gold is still down about $8 this morning, or as we speak, while silver is actually in the green, only by 12 cents. But it's reacting differently than gold. Any explanation there? Does it make any sense for you?
Well, silver tends to oscillate at a wider pattern than gold. If gold goes like this, silver tends to trade a lot wider. And silver was way oversold at under $19, down around $18. And we are in a bit of a physical silver squeeze here in the US for products. Whether that's contributing or not to the silver price moving up ahead of the gold price, it's hard to say at this point in time because that's just happening. But silver is actually leading gold at this moment in time, which is very unusual. And some of it may have to do with manufacturing. A lot of silver is used in manufacturing, solar panels, electronics, electronic vehicles, where gold is the currency of last resort. So we don't really have a problem with the fear factor in gold. I think people are just sensing that silver is oversold and it's catching a bit more than gold right now for that reason.
No, we don't often have bullion dealers on the program, so I'm going to tap into your area of expertise there. And Dana is like, what does it look like in terms of demand right now? You see inflation very high. Like, are sales through the roof? Are they slower? Are they fat? Like, can you give us a bit of a sense of what is happening right now for you or in your business?
Sure, sure. Well, for 2020 and 2021, once COVID hit and all that government spending was dramatically increased, our sales quadrupled as an industry. We were suddenly went from selling about 70% of normal business to 4 and 5 times normal business. And we had that for most of 2020, 2021. So we have seen a drain in, COMEX supplies of silver over the last couple of years because of that. In 2023, sales have been good. They haven't been great like they were the last 2 years, but they're still strong. And we've seen a bottleneck, particularly in the 1 ounce sovereign minted silver coins physically. If the gold to silver ratio is 85 to 1, which is about where it is, it takes 85 ounces of silver, those blanks, to equal 1 ounce of gold. So the time and effort to make the similar dollar amount in silver is a lot higher. And the bottleneck is the blanks. So we're not seeing enough of the blanks being made, and demand has outstripped the mints around the world's ability to produce 1 ounce coins. So we are in a silver squeeze. And now that the 1 ouncers are problematic, especially the US Silver Eagles, which the US Mint has just been way behind the production curve this year. They're making far less than they have. Premiums for Silver Eagles are abnormally high at $16, $17 over the spot price, almost double the spot price, which I've never seen before in my career. We've been negative selling those against coins like Canadian Maple Leafs or Austrian Silver Philharmonics or South African Silver Krugerrands, but even those are in tight supplies. And now that's rippling down into the bar manufacturers, the 100 ounce bars, 10 ounce bars. So premiums for these other products are higher than normal, not abnormally high, but they're still, you're paying $2 and $3 an ounce more than you would in a normal market. And that's just because there's not enough product to meet demand. And until the 2023 products, and we're in a transition phase here too. Plus, the Queen died. Now, who thought the Queen would screw up the silver market when she passed away? But her picture is on 3 of the major products, Britannia's, Maple Leafs, and Australian kangaroos. So the Canadian Mint stopped production for about 3 weeks till they figured out what they were going to do next during the mourning period. And that came right at a critical time. Plus the low silver price, under $20, has created a lot of demand. So it's been a couple different waves of hit us, all culminating in higher premiums for physical. And we're going to be in this phase until the 2023 products start flowing in earnest sometime during the first quarter of next year. So the price on the street for physical silver is $24, $25 an ounce when the spot price is $19 an ounce.
Dana, allow me a naive follow-up question to that. And again, it's like I'm not the bullion world is not my world. I have to admit, I'm more on the stock side. But curious, like who sets the premium?
Well, the mints sell to their distributors, and I'm not a mint distributor. I'm not big enough. So the US Mint has 12 different worldwide distributors that they sell to. And the business that you do with the Mint alone is 50 to 100 million a year, right? So if the Mint says you're taking 200,000 Silver Eagles this month, you're taking them, right? And then it's your job to sell them. So when everyone's flush with supplies, premiums are low, and it's a very competitive market. When there are less physical supplies, there's less units to sell, and these are businesses that have to be profitable. They simply have to get more for that same unit. So the distributors charge what the market will bear to secondary dealers like myself who deal with the retail public, right? So it's the Mint distributors are making more money right now than they might otherwise, because the Mint charges aren't necessarily as high relative, although the Mints have raised their rates too, because they can get more as well.
So, Dana, another question. I'm not sure if you can answer it, but what are you advising your retail clients right now? Because looking at the premiums, which are pretty much 100% above, the market price per ounce, what are you advising right now? It's sort of, it feels like a question I'm asking at a restaurant when I'm asking the waiter what's best here, and they always say everything, right? So,
Right. Well, when the premiums on the Silver Eagles got very high, we stopped selling them, or we told people there are much better values to be had. So we focused on Maple Leafs next, and then Philharmonics, Krugerrands, and Australian Kangaroos, depending on who had the lowest premium, where we could get supply at the lowest premium. But most of that, what was available, and there were pockets here and there of different products that were cheaper. That's what we would offer our clients to try and get them the best value, right? Because at some point in time, those clients are going to want to sell back to us. And when they're paying too high a premium in a normal market, they're not going to recapture that on a resale basis, usually, right? And I don't want to be the bearer of bad news telling my client, hey, I sold you a bill of goods, recommending an overpriced product when you could have bought something more reasonable. So that always is what governs how we recommend to our clients, because our clients are our most valuable asset. If we don't have clients, we don't have a business.
They usually keep coming back as well in this space.
Right.
So,
we enjoy a good repeat and referral business as well. And that's because we try and treat everybody very, very fairly, and we're very competitive. But it's an unusual market. We've been in this phase a couple times over the last 10 years. Following the great financial crisis, we had a squeeze. Following COVID, we had a squeeze for about 3 months. We're in another one now. It's not unusual. And we do game a bit forward production. So we anticipate what the Royal Canadian Mint can deliver over the next month, what the South African Mint can deliver, what the Austrian Mint can deliver. But right now they're making less of the current year, 2022, because they're gearing up for 2023 production. And those coins aren't released yet. So it's just a culmination of a couple different events creating a squeeze in higher prices, premiums.
interesting. Like, how does supply out of the ground play a role in this? Is there enough supply coming out of the ground? Because I've looked at the numbers. I think we're actually in an oversupply situation on the silver side right now.
Yeah,
by a few, I don't know, 80 million ounces a year or something. It's not a huge number, but like you probably know this better than me. I'll just let you discuss.
Well, I'm not a mining expert, to be honest with you. So there is enough silver coming out of the ground, but there's a lot more attrition in silver for other uses, in industry, which we don't have in gold. Most of the gold that comes out of the ground stays above the ground and is eventually resellable, where silver has a much higher attrition rate in use for manufacturing and creating things. So we do get into a bit of a silver squeeze. If you look at the COMEX warehouse, we've seen a big drawdown there, but there's still a lot of bars. I mean, you can buy 1,000-ounce silver bars. They're not easy to trade. They weigh 70 pounds. They're about this big, and they're hard to ship because of their weight. If you want to sell something, you can't sell half a bar without a hacksaw. So you can still buy, big bars economically, but the smaller bars are even problematic right now. 100-ounce, 10-ounce, 1 ounce in particular.
Interesting. I was just researching a quick question, like, because I was looking at the CME COMEX report as well, and since you brought it up, and I was going to ask you the difference between registered and eligible silver ounces at the CME or at the COMEX, right? Because the registered is only at 34 million ounces, which is
nothing.
Right? But
Right.
if I look at the eligible, then it's of course way more, and it doesn't look like we need to panic. But explain that difference to me, like I'm 5 years old.
Well, that's again, that's not something that I'm an expert
Yeah.
on. So that's something I've just been following myself. So I would hesitate to make a comment for fear of making myself look foolish. I'm
No,
sorry.
all good, all good. That's why I'm asking the question because I don't know either. So that's, but I found it interesting because I see those charts pop up on Twitter, and they're saying, "Oh, COMEX levels at the lowest ever," but it's like I don't understand it. That's why I'm asking the questions.
Well,
Right?
I was having dinner with the president of one of the U.S. mint distributors the other day, and I was saying, "Hey, is this silver squeeze really that bad on the COMEX warehouses?" He said, "No, there's a lot of silver out there. Don't worry about that." I'm like, "Okay."
Okay.
So that's anecdotal, but it's high level anecdotal information.
Oh, fantastic. No, Dana, just trying to think. Like we talked about the markets, we talked about the physical part, and I think we covered the topics I wanted to talk about. We have a fantastic conversation. Like I ran out of topic. I wanted to maybe talk CBDCs, but that's a little bit far off from where we're coming from right now. We'll save that for the next time. We'll definitely have you back on maybe in February to sort of see how the midterm elections played out and how the markets have behaved over the winter as well. Dana, really appreciate your time. Glad you made an effort to come on. Really appreciate it. Thank you so much.
Kai, it's been wonderful getting to meet you and getting to know you, and I wish you the best. I know that you're going to have a challenging next couple of months, so the best of luck to you.
Yeah, I'll just keep my computer on because that thing is heating up the room like you would not believe. Fantastic. Dana, thank you so much. And everybody else, thank you for tuning in. We hope you found this very insightful. I sure did. Make sure to follow Dana. He's also on Twitter and LinkedIn. Go visit the American Gold Exchange as well. They have a fantastic website with daily commentary on the gold price as well. And leave a comment, leave a like, hit that subscribe button here, and we'll have lots more for you. Thank you so much for tuning in.